Before jumping into elasticities, there was one other topic I wanted to touch upon regarding market equilibrium, well, in this case, market disequilibrium. Here on the screen, I have a couple of scenarios. We're going to consider a price change, an arbitrary price change. Perhaps a firm didn't hit their profit goals and they feel they can raise prices. Perhaps consumer demand increases a little bit, and that leads to a higher price if there's this entire shift in the demand curve to the right. There are all sorts of different scenarios that we can entertain, but for right now, let's just consider that there's only a change in price only. I'm just going to jot that down here. Here's some stipulations. There is a change in price only for both of these. Okay, so if there's a change in price only, what does that mean when it comes to determining what the new equilibrium is going to be? And of course, equilibrium, as you know, is where the supply and demand curves intersect. Well, that means there's going to be a movement along either curve, either the supply or the demand curve. If there's a change in price only, curves do not shift. Do not shift. Important concept to remember. So, for this first scenario, let's just pretend that for whatever reason, firms, suppliers, raise prices. And that could be because earnings expectations were lower than what were forecasted. There could be any other reasons, really. So firms raise the price, and what we have here is just a change in price only. Again, we have a movement, right? So let's say price goes from our equilibrium price here to, let's call it here. So again, we have a movement along the supply curve because this price change was initiated by the firm. And you remember from a previous video that when the price changes, increases or decreases, we arrive to a different equilibrium, market equilibrium than where we were. You could even call it disequilibrium if you like. So here we are at this new increased price moving along the supply curve. So our new price is going to be just about like that. And here we can write our new price equilibrium. I guess we call this maybe PE prime. And obviously, even though price was initiated on the supply side, here is where price intersects, the new price level intersects the demand curve. So we see that there's kind of there's a difference in the directions. When a price increases, it moves up along the supply curve, up along the demand curve. Now we're looking at this from sort of on a y-axis perspective, but let's take a look at the x-axis and see what's going on there. Now, as you can see, what I've drawn here is our price increase. You can call this, I guess, I labeled it as price equilibrium prime. You could probably just ignore that for now. It is in disequilibrium. But what are we seeing here? Price increased from the supply side. And if price is now at this level, that price level is now going to intersect the demand curve here. And if you move upward along the demand curve, after price is increased, and I hope you already know the answer to this, after price is increased, what has happened to quantity demanded after a price increase? Well, pretty simple. Quantity demanded, we started at equilibrium, but quantity demanded has moved to the left on the x-axis. That is a decrease. That is a decrease in quantity demanded. Quantity supplied with a price increase, given that there's less demand, moves to the right. So quantity supplied is higher than quantity demanded, as you can see as to how it worked out here on the x-axis. So what has this movement in price, this change in price, caused? Well, obviously the $1 answer is obviously market disequilibrium. But if quantity demanded here is to the left of quantity supplied here, given this new price level, the price increase, quantity demanded is less than quantity supplied. This results in what we call a surplus. There are more goods and services out there to be bought. These are little packages of goods and services, and there's only like maybe one or two people that want to buy them, right? The demand is so farther to the left of supply. Supply is really high up there, because with that price increase, obviously given the law of demand, with a price increase, quantity demanded will decrease. So this is where we have our surplus. We have a surplus because our quantity supplied is greater than our quantity demanded. Quantity supplied here is greater than our quantity demanded here. So if there's more stuff, really, to be bought, but because price went up, there's less purchasers of that stuff, we have a surplus of, stuff. And that's what you can see in this sort of triangle here. And I know it's a little counterintuitive when you think surplus or shortage. The surplus, you would think, would maybe be on the opposite side of the graph, maybe below of the original equilibrium, but this is how that works out, where quantity demanded is so much less than quantity supplied because of this temporary disequilibrium. Do the markets correct eventually? They might, and usually do, and maybe we get back down to equilibrium. Maybe the prices decreased maybe to about here, and then we have to figure out a new type of equilibrium. But with a price increase from the supply side, from the firm saying, hey, we're going to charge more, you are going to have less buyers, which means these firms are going to have more of their product, boxes of their stuff stacking up on their shelves. Then there are people willing to purchase them again because of the increase in price. An increase in price leads to a decrease in quantity demanded. I'll stop this video for here and continue on with the graph on the right side and work through an example, the opposite example with that one. So stay tuned. Cheers.